Index Universal Life for Dummies. This episode will take you from the very simplest life insurance 101, how life insurance works, the various types, how Index Universal Life came about, and how it works. Get ready. I'm going to bring this down to a very, very simplified level, and hopefully you're going to gain insights into why cash accumulates inside of a life insurance policy and the best way to do that. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize their assets and minimize taxes and empower their authentic wealth. I started clear back in 1974, so I've been around the block. I might have an Apple Watch on right now, but my first watch was a sundial. My first pet was a dinosaur, okay? And so I'll go clear back to 1974 and explain how Universal Life and Index Universal Life came about. But let's start with how life insurance works, first of all, okay? So this is Life Insurance 101. Up here at the top, you see I have the year 1958, 1980, 2001, 2017, CSO. That stands for Commissioner's Standard Ordinary Mortality Table. Now, mortality is your life expectancy, how long you're expected to live. So when we talk about life insurance, the companies insuring your life are going to calculate your life expectancy based upon mortality tables, based upon your age. And so when I first started, back in 1974, they were using the 1958 mortality table. And then generally speaking, with medicine and so forth, we end up eliminating some of the deaths that used to happen because of advanced medicine. And so every so often, every 20 years or so, they'll come out with a new mortality table. And so, for example, when I started, if you had a group of 30-year-olds, for every 1,000 30-year-olds in America, I'm talking about males here, there were 2.13 deaths per 1,000, okay? And for 40 years old, there was 3.53. Age 50, there were 8.32. So the older you get, the more 60-year-olds, there's 20 out of 1,000 60-year-olds that die in the year that they turn from 60 to 61 years old, okay? Now, when we went to 1980 mortality tables, this 2.13 changed to 1.93 or something like that. And so what happens is through the years, the deaths per 1,000 go down a little bit. I don't want to complicate this, but this is what helps life insurance become cheaper through the years based upon insurance companies using the most recent mortality tables, which is like the death rate, okay? So now there are different types of insurance. Basically, there's term insurance, whole life insurance, and universal life. And within the whole life and universal life, there's variable, there's indexed, there's all kinds of different options. We're going to keep it simple here, where we're not using a variable product, where you're taking the cash value and invested it in the stock market. So let's keep it simple right now, okay? Now, over on this side of this graph is COI. That's the cost of insurance, okay? And I'll explain what I mean by that. And here's the ages. We're going to start with 30-year-olds, 40, 50, 60-year-olds, 70, 80, 90, 100-year-old people, okay? So on this graph, we have the cost of insurance. Now, all life insurance has a term insurance component in it, okay? That's the actual pure mortality cost, the actual cost, the risk of how many people will die. And as you see here, if I were to plot this out between age 30 and 40 with 10 dots, generally speaking, okay, there's more and more deaths per 1,000 of the American population clear out to age 100. That's pretty easy to understand, right? Now, let's say with term life insurance, and I'm talking about where you pay the annual premium and the premium goes up every single year, okay? So to simplify this, let's say we had a fraternity, and it's made up of 1,000 men, okay? So 1,000 males, and we're all 30 years old, and we're back before 1980. And as we gather together, we realize that next year when we meet for our convention, 2 of us won't be here. Based upon statistics, 2.13, I'll round down to 2. 2 of us are going to die, maybe 1 by accident, and maybe 1 gets cancer or whatever, okay? But 2 are going to die out of the 1,000 of us. And so let's say we decide, you know what, let's pass a hat around the room here, and everybody chip in so that we can give $1,000 with a sympathy card to the family of the 2 that are going to die, okay? Does that make sense? So let me ask you, if we passed a hat around the room to 1,000 people in order to raise $1,000 for the 2 winners, I mean, those who are going to die, how much does everybody need to contribute? Every one of the 1,000 people needs to chip in $2. Do you understand that? Okay. So 1,000 people chip in $2 as we pass a hat around the room. And now we have $2,000 on hand so that when the 2 die that year, we'll have $1,000 for each of their families that they left behind, the beneficiaries. That's term insurance. Okay. Now, it gets a little bit more complicated because, of course, insurance companies, they can sort of reduce the cost for them. They may collect $2 if they want, but maybe because they had these 1,000 people take medical exams, or they looked at their medical history and they saw that one of those 2 has had several DUIs and they were addicted to drugs or whatever. We don't let them put just $2 in the hat. We don't let them put anything in the hat. We won't insure them, so they're uninsurable. Or maybe they're a little bit higher risk because they've gotten a few tickets, and so they have to pay $10 or $15 or $20 in the hat because their chance of dying is much greater than the rest of us. Okay, that's called a rating, and that's based on risk. And so insurance companies will rate people if they're still insurable, but they have to pay more money to be insured. Does that make sense? Okay. So that's what term life insurance is. Now, all insurance has that pure mortality cost inherent in it. The insurance company must have that money on hand to pay out to the people who die. And they have to charge the appropriate amount of the risk they're going to incur to pay out a death benefit when those people die. Okay? Now that's term insurance. Now whole life insurance, that covers you for your whole life. That's why it got that name. So whole life insurance is where we take a 30-year-old and instead of having them put in $2 for every $1,000 of life insurance they want, and so if they wanted $100,000 of insurance, then instead of having to pay $2,000 a year for that, they're putting in much more than that, okay? So whole life insurance is where you're paying way more than the actual mortality charge. You would be paying way more than $2 per thousand of life insurance. You'd be paying $20, $30, $40, $50, $100 or whatever. And so you're way overpaying for the actual chance that you will die that year, okay? You're overpaying. And every year you get older, you're still overpaying until a certain age. It's usually about age 65, let's say, where it crosses over. So whole life insurance, you're overpaying for the insurance the early years. And then at age 65, you're going to still pay the same premium your whole life. And the insurance company is saying, because you overpaid, we have this extra money on hand, and we'll call it cash value. It's equity, like equity in a house. It's cash value in your policy that we're keeping on hand. and we're going to give you some interest on that money, and we're going to keep that on hand so that when you turn age 65, you keep paying that same premium. You're underpaying, but this cash will make up for when you're underpaying so that we have the money to pay these higher premiums for the actual cost of the term insurance in there, so that you're covered for your whole life, but you only had to pay the same premium your whole life. Does that make sense? So whole life, you pay the same premium for your whole life. You overpay the early years, which creates cash value in the policy. And then that cash value is there to cover when you're underpaying later in your life. And so they can take some of that money and interest on that money and keep the life insurance risk covered. Does that make sense? Okay. And sometimes these insurance companies pay you interest and dividends on this money and what have you, and it's tax-free. The beauty of it is anything that you earn in that is tax-free. So all this money, this cash value is credited interest, and it grows tax-free because the government realizes, why would you tax an instrument where this person is trying to take ownership of their future and be responsible, whether they die sooner or they live a long time. They're trying to make sure their widow and orphans are not dependent on the government. So it's tax-free. And so that is protected under Section 72E of the Internal Revenue Code. So that's whole life. Now, then they came out with, well, what if you don't want to pay your whole life? Well, then you could pay a higher amount of money, a higher premium, up till age 65. And so you pay more money in there. You have more cash in here, and it's accumulating. And so now you pay, and you can stop paying premiums, let's say at age 65. Sometimes that was called paid up at age 65 or whatever. And the insurance company, because of the guaranteed interest on this overpayment, which is a bigger overpayment, will cover you for your whole life, and you don't have to keep paying premiums after that time period, okay? Now, they said, well, golly, what if I want to just pay in here for 20 years? So, yeah, you could pay into this whole life policy for 20 years. Now you're having to pay more money, way overpay, so that in 20 years you stop, and now all this cash is growing with interest that will cover the rest of your life because you put in more money. Does that make sense? Well, then maybe you pay 10 pay. You pay premiums, way higher premiums for 10 years, and then you stop, and all that cash grows with interest like a bank. And but it usually earns a little bit better interest than a bank and an insurance company. And so that cash will cover you your whole life, even though the cost is going up. So far, so good. So that's what was around up until 1980. Then in 1980, E.F. Hutton, who was a brokerage firm, they said, well, wait a minute. This is all tax-free. What if we just use this cash while we're alive? Because under Section 7702 of the Internal Revenue Code, you can access this money in here. You can borrow from the insurance company using this as collateral. You can access this excess money if you want, and it's tax-free. And E.F. Hutton said, well, golly, what are we thinking here? Instead of having our clients buy term insurance and investing the difference in the volatile stock market to try to outdo whole life, maybe we take the least amount of insurance that the IRS will let us get away with and put in the most premium they will allow, okay? Now, what I just said is this. See, if I paid a huge one-time premium, that was called single premium life insurance. So instead of paying 10 years, you pay this one-time premium. You might pay at age 30, $200,000 cash for $1 million policy. If you were 50 or 60, you might be paying $500,000 cash for $1 million policy, okay? Because they do the math, that's called actuarial tables, and they would tell you how much you would have to pay in order to be covered for your whole life, so that whenever you died, they would pay out $1 million tax-free. But if you needed some of that money for your life to access it, you could get the money out of there, you could withdraw it, or you could even borrow from the insurance company based on how much cash value you had, and it's tax-free. And E.F. Hutton just said in 1980, wait a minute. Most people, they try to get X amount of insurance, $1 million of death benefit, because that's what they want in case they die. And they want to know, well, what's the least premium that we can pay to be covered for $1 million our whole life? E.F. Hutton did the opposite. They said, wait a minute. Look at what it's doing here, tax-free. Why don't we use it for life? If we use it for tax-free accumulation of money, let's take the least amount of insurance and put in the most money, because we're not doing it primarily for death. We're doing it for the tax-free. We're self-insuring. We're gonna take ownership of the risk instead of transferring it to the insurance company. Now, this is hard for some people to understand, but this is where you're self-insuring. So when Index Universal Life came out, max funded IUL, when it first came out in 1980, I had clients that said, oh, I have $500,000. And they would put $500,000 into a $500,000 life insurance policy. And people would go, well, who pays $500,000 for a $500,000 life insurance? When you die, it just pays out what you put in there. Well, they said ours did because they want their $500,000 to generate $50,000 a year of tax-free income, because it's earning a rate of return. Back then, it was earning 10%. They did it to put in $500,000 and then pull out $50,000 a year, and it's tax-free because they way overpaid, and they did it in one fell swoop. So they were doing it for living benefits by way overpaying, okay? And so then some laws were passed. And so usually the fastest you can fund Index Universal Life now, which didn't start until 1997. In 1980, it was called Universal Life. The fastest you could fund it after 1988 was in 5 years. So if somebody had $500,000, I had to wait and put in $100,000 a year for 5 years in order to have tax-free access to the money. Before 1988, they could have tax-free income instantly, okay? Now you have to spread it out. Slow the flow is what they did, because the banks and the brokerage firms couldn't compete. So IUL is you're putting in as much money as you can. You're taking the least amount of insurance, not as much as you can get, the least amount, so that this cash is available to you for tax-free income instantly or during your retirement years. Okay? And it just grows like crazy, tax-free. But your cash value grows to equal and exceed the death benefit within 10 years. Okay? So that's how it works. IUL is your maximum funding. You don't have to, but that's how it was designed, okay? And that's what my clients do. So here's how it all worked out. For over a century in the Internal Revenue Code, what I just mentioned is money that grows inside of a permanent cash value life insurance policy, whole life or universal life, grows tax-free under Section 72E of the code. All the interest, the dividends, and growth, you don't have to pay tax. Section 7702 of the code dictates how you can access your money without paying tax on it. All the game, tax-free. And then Section 101A says that is at the end of the day, when you finally do die with that life insurance policy, it will transfer income tax-free. And it will increase in value and transfer income tax-free. So that's what E.F. Hutton realized. They said, oh, wow, nothing else does that in the Internal Revenue Code. So why don't we take the least amount of insurance we can get away with? And so I had clients back in 1980 putting in $500,000 in one fell swoop, and they immediately started getting $50,000 a year of tax-free income. It was incredible. But the banks and brokerage firms complained. The IRS even said, what are you doing? We think you're overstepping your bounds of tax-free in the code. So they took E.F. Hutton to court. E.F. Hutton won. They weren't doing anything wrong. But then the IRS went to Congress and said, we got to change the definition of tax-free under these 3 sections of the code. We think you're abusing them. So in 1982, under the Tax Equity Fiscal Responsibility Act, spelling TEFRA, they dictated the minimum amount of insurance that had to be required if you were doing it for living benefits. You couldn't buy a dinky little tiny life insurance policy and put a whole bunch of money in it. You had to have a commensurate amount of insurance based upon your age, your gender, and your health, okay? They didn't know quite what they were doing in 1982. And so 2 years later in 1984, under the Deficit Reduction Act, which spells the acronym DEFRA, this TEFRA, DEFRA, these tax citations, these are tax laws, they dictate the minimum amount of insurance required, but it gave parity. What's parity? Equality. What does that mean? If people were taking out the life insurance primarily for living benefits, for tax-free accumulation and tax-free income, it gave parity so that if that person was maybe 20 years old, in great health, and they wanted to reposition, let's say $500,000. There's nothing magic about $500,000, but I'm going to use that as an example here. If they wanted to put in $500,000 and have the least amount of insurance, they might have to have 4 or 5 million of life insurance because the cost of the insurance is very low at that point because of the term insurance in there. Now, if they were 60 years old, they might only need $1,250,000 of life insurance to accommodate $500,000 of overpayment of premiums, okay? If they were 80 years old, they might only need $700,000 of life insurance to accommodate $500,000. But it doesn't matter how old you are, the cost of insurance is the same for the 20-year-old as the 60-year-old as the 80-year-old. But you say, wait a minute, Mr. Andrew, you just showed me a graph that says the cost of insurance goes up as you get older. Well, yeah, the cost per thousand goes up, but the amount of thousands of life insurance risk is less the older you are if you're trying to use it for living benefits. So you get to squeeze down the death benefit so that if you're earning a rate of return that averages 9%, then your net internal rate of return, cash on cash, is 8. If you earn 11, like I've averaged, you net 10, okay? The cost of insurance is only draining out about 1% of the cost, retroactive back to day one. So you want the insurance to be the least cost possible. And so the older you are, every year older you are, the less insurance that is required so that just like a 20-year-old, you can earn 9% and net 8%, tax-free after all the costs on your money. That's not tax, it's tax-free. It's the cost of the insurance based on that graph, okay? And so even if you're unhealthy, but you're insurable, you can, if you're required to put more money in the hat, so to speak, you can even get away with less insurance. Back in the 1980s, I had a 78-year-old that had 3 blocked arteries, adult onset diabetes, a prostate cancer episode, 6 sisters, all predeceased him, and 3 brothers. We shopped several insurance companies, and he was rated what is called Table D. He had to pay twice as much as a normal 78-year-old. He had the life expectancy, the mortality of an 83-year-old. Once I knew that, he wanted to put in $500,000. Why? To pull out $50,000 a year tax-free. He wanted a 10% return. He wanted to earn 11 and net 10 back then. And so if he was healthy at a 78-year-old, he would have been required to have about $850,000 of life insurance. But once we found out he was rated, we just squeezed down the life insurance down to $700,000. And all of a sudden, the cost of his insurance, even though he had those health issues, was the same cost as a 22-year-old athletic marathon running female. So the cost of insurance is the same and it goes down. It gets cheaper as you get older when you do this, okay? So that's TEFRA and DEFRA. TAMRA came out in 1988. That's a Technical and Miscellaneous Revenue Act. TAMRA was forced by the banks and the brokerage firms, the credit unions, because there was this massive departure of money from the banks, credit unions, mutual funds, over into these, because these were safer. They paid higher interest. They were tax-free. And they paid out more when you ultimately died. There's not a bank around that could do that, or a mutual fund. And so they didn't want to kill these because this is where banks and credit unions borrow your money. When you put money in a bank and a savings account, it's in a lended position, okay? They're paying you interest, but they're not just putting it in a vault. They're putting your money to work by loaning it out, but they put 30 to 40% of their tier one assets. That's money they have to have on hand, liquid and safe in case there's a run on their bank and everybody wants their money. They put it in insurance companies, the multi-trillion-dollar insurance industry, which is the backbone of America and the backbone of the world. In the Great Depression, banks closed. 40% never reopened their doors again. Real estate dropped in value as much as 80%. Not one single legal reserve insurance company went under in the Great Depression. In 2008, 400 banks went under. 900 more were on the brink of going under. Not one single legal reserve insurance company went under in 2008. The federal government asked the 5 major banks in 2008 to disclose where they had their tier 1 assets for liquidity and safety. It was in insurance companies, in BOLI. Banks were paying less than 1% interest. On every $1 million people deposited in their bank, they only had to pay out $10,000 a year in interest. They turned around, and if they put that in an insurance company, in bank-owned life insurance, see, it's the owner of these that gets all the tax-free income, okay? They were turning around and making 5% or higher. They were making $50,000, and they only had to pay out 20% of that to the depositors who gave them the money. They were making 5 times more than they were paying you that had the money in the bank. And they were increasing the safety of their money by 5 notches or 6 notches, because a lot of banks were only rated BBB. A lot of these insurance companies we use are rated AAA. That's 6 notches higher in safety, and you can earn a rate of return 5 times what the bank was paying you. That's why this is so incredible. And so the banks didn't want to kill these because this is where they put their money. But they wanted to slow the flow. So under TAMRA, if I had a client that wanted to put in $500,000 in one fell swoop, they couldn't do that. Well, they actually could do it, but it would no longer be tax-free when they went to get their money. It would only be tax-deferred. Now, if they died, it would blossom into a death benefit and pay out income tax-free. Life insurance death benefit is always income tax-free. But if people are doing it for living benefits, they want it to be tax-free, so they have to comply with TAMRA. So TAMRA made you spread it out. Whole life insurance, you have to spread it out over 7 relatively equal payments. But with universal life and index universal life, you can get the money in there in 5 or even 4 installments, okay? So here we go. I like to compare this metaphorically to a bucket. If I have a bucket and I want, and this is a life insurance policy, IUL, I want to be grandfathered, so to speak, to be able to put in X amount of money. I want all my compound interest to be tax-free, and I have to have a minimum death benefit based on TEFRA and DEFRA. And under TAMRA, I might only be able to put in $100,000 a year before I get my $500,000 in there, if I'm using that as an example. So let's use an example of this. If I have a male age 60 and they want to put in $500,000, if they want to be able to access that money and all the growth on it tax-free, okay, under TEFRA and DEFRA, the minimum death benefit now is only about $1 million. Whole life actually requires more life insurance. It's more expensive. And whole life takes 7 years to get this in there. With index universal life, I can actually now get about $125,000 in there the first day of the first year if I have it. The first day of the second year. Now, you don't have to have big lump sums. You can set these up for $500 a month. I'm just simplifying here. But I could get in half of this within 1 year and 1 day. See? So in 2 payments, I can have that in there, and then the third and then the fourth. So as little as 3 years and 1 day, in 4 payments, I could get my $500,000 in there, and now I have complied with TAMRA, which means now any money I go to access out of here is totally income tax free. It's worth doing. And so that's why it behooves you to go to an insurance agent that understands this. So folks, this becomes a cash cow. Now, when I talk about self-insuring, you can actually choose to have this money you put in there added on top of the $1 million if you die. But that means the insurance company on that line is going to keep charging you more every year for this spigot on the bucket, which is the cost of the insurance, which the IRS says has to be there if it's going to be tax-free. Because if you violate TEFRA, DEFRA, and TAMRA, you violated those 3 sections of the code, and now it moves over to the investment section of the Internal Revenue Code. Now it's going to be taxable sooner or later, and it's going to be subject to market volatility. If that's the definition of investment, I don't want that. I want tax-free insurance. So you comply with TEFRA, DEFRA, and TAMRA. And so you comply here so that you can choose to have the 500,000 be part of the million if you want the best rate of return, if you want the cost of the insurance to get cheaper as you get older. Have you ever heard of a life insurance policy that gets cheaper as you get older? Then you haven't seen one done like I'm talking about here. So let me show you quickly how it works. If I put in 500,000 and I die, and I choose what is called the level death benefit, the insurance company is just going to pay out $1 million tax-free. Now, it's still one heck of a return. I got double my money, but I didn't do it for that. I did it for the rate of return. I want the cost of the insurance to get cheaper, and it has. The cost of insurance is half. It's now half of what it was because the net amount at risk, the insurance company now is only on the hook for the difference between the original death benefit when I started and my money. There's actually interest on this, but that would only be the remaining 500,000. So the insurance company is only deducting the actual cost of the net amount between the cash value and the death benefit. Hello? It's getting cheaper. It's half as much. Now, my average return on Universal Life and Index Universal Life since 1980 has been 9.62 net, cash on cash, because I diversified. 9.6 divided into what is called the rule of 72 means my money will double every 7.5 years. So in 7.5 years from this 3 years and 1 day, okay, so in the 11th year, my $500,000 now has doubled to equal the death benefit. What's the net amount at risk now? 0. My cash has grown to equal the death benefit. That's called self-insuring. My insurance got cheaper until I got older. Now, technically speaking, if I died, the insurance company pays out 5% more, $1,050,000. But if I have $1 million of cash in there, I can pull out $80, $90, $100,000 a year of tax-free income using that money as collateral the rest of my life, and it's tax-free. It knocks the socks off of traditional IRAs and 401ks. That's why we use it. It's the dream solution for college funding for your kids and grandkids, a working capital for business, emergency funds, all kinds of reasons. You don't have to just use it for retirement. You don't have to wait till you're 59 and a half to access the money. There's no 10% penalty, okay? Now, here's how it works. If I don't need income when I have $1 million of cash in there, I wait another 7.5 years. I don't add any money to it, and it doubles to $2 million. Now, if I die, they pay out $2.1 million, but they're only charging me for 1/20th the amount of risk, 100,000 of death benefit. They would pay out $2.1 million in about the 17th year if I died. But they're only charging me for 100,000 of risk. I'm making so much interest on the other 2 million that the spigot is even getting smaller, which means if I earned 11% in the 17th year, I would be netting about 10.9 cash on cash. But we simplify it to say, well, retroactive back to day one, if you were averaging 11, you'll probably net 10. If you're averaging 9, you'll net 8. About 1% goes out this spigot for the cost of the insurance that has to be there, or it's not tax-free. You would have to be earning 12, 15% in a mutual fund, in an IRA or 401k to net 10 after tax and fees. I only have to earn 11 to net 10, and that's why E.F. Hutton said, this is way better than putting people's money in volatile mutual funds that are going to be taxable sooner or later. Now, this is compared to like a 5-story office building, okay? If the IRS said, Mr. Andrew, you build a 5-story building, and tell you what, if you just rent out the first floor the first year, and then the second floor the next year, and so forth, if you take 5 years to fill it up, all of the rental income on that piece of real estate will be tax-free forever after. I would do that in a second. That's what Index Universal Life is. If you wait and fill it up, according to TAMRA, all of the interest and all of your income will be tax-free forever. That's the beauty of it. So that's why we want to comply with TEFRA, DEFRA, and TAMRA. Now, the last thing is indexing. See, Cresmont is a research company, and they said if you look at the last 50 years in the stock market, if you simply eliminated all of the years where the market went down, and usually 30% of the years the market went down, You just eliminate those. You didn't lose. You would only need 25% of the up years to outperform the stock market. That's where indexing comes in. So with indexing, when I get $1 million in my IUL policy, let's just look at that. If I feel like, we're headed for a recession, I think the market's gonna crash this year, I just can settle for the general account portfolio. That's called GAP, general account portfolio rate. The insurance company on my $1 million, they're investing my money and everybody else's into mortgages on shopping malls and skyscrapers, into preferred stocks, AA and AAA bonds. And so they earn 4% is about the lowest. They've earned as high as 15.5%. I'm just going to use the lowest, 4%. So if I feel bearish about America, that I think that the economy is going to go down, I'll just say, just pay me 4% tax-free. At the end of the year, I now have $1,040,000. But in a year, I feel like, I think the economy is going to do well. I feel bullish about America. I tell the insurance company, don't you put one dime of my $1 million at risk in the stock market. But I am willing to give up the 4% interest, this $40,000. You do whatever you need to do with that $40,000 to have the wherewithal to pay me whatever the market does. And so I can choose different indexes like the S&P 500, the top 500 corporations in America. That's a very famous index. So if the S&P goes up 8%, the insurance company pays me $80,000 that year tax-free. If it goes up 12%, they pay me $120,000 tax-free. How can they afford to do that? Because 40,000 of options doubles and triples. They know what they're doing. But if I guess wrong and the market tanks, if the market crashes like it did in 2008, it drops 40%. My $1 million doesn't go down to 600,000 like people who have money in the market. I still have my $1 million. The options just expired, worthless. I didn't make anything, but I didn't lose. How incredible is this? This is explained in my book with this diagram here. So folks, the book is the L.A.S.E.R Fund. And in the Great Recession, people in America who accumulated $1 million their entire life, and they decided, okay, I'm going to retire. I have $1 million. And all of a sudden, after the 9/11 terrorist attacks, what happened? That $1 million went down to $600,000. They felt like they lost their future. They had to put off retirement 7 years because it took 4 years to come back up to break even. Our clients with Index Universal Life, they didn't lose a dime when it went down. And they actually made 5%, the general account portfolio rate. And then at the end of this time period, many of them had $2 million for the million when most Americans were barely back to break even. And then what happened in 2008? It dropped, and again, 30 or 40%. Our clients were cheering, go, because they weren't losing. They may not have made anything, but they didn't lose. And it took 4 years until 2012 before people with $1 million finally had $1,046,000, barely above break even. That's only 1/3 of 1% compounded rate of return over 12 years. Our clients with IUL, their million was worth $2.5 to $3 million at the end of that 12-year period when everybody else in America was barely back to break even. So my message here, folks, is this. When you look at your situation, don't be part of the 95% following traditional advice and yet to be taxed IRAs or 401ks. You're going to be in captivity and outlive your money. I want you to arrive at the land of peace and abundance, be part of the top 5%, have tremendous financial freedom, have several $1 million, and the missing structure between these people and these people is disclosed in my book, The L.A.S.E.R Fund. So you can buy this on Amazon for $20 up to $60. If you do, thank you. But I'll gift you a copy for free. Simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book. I'll fire out a hard copy to you via priority mail. And when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those options available. But you can register for a free educational webinar. You can even schedule an appointment with an IUL specialist to see how a properly structured indexed universal life insurance policy, structured correctly, funded properly, may work in your particular set of circumstances. So please do that. This is 2 books in one. This side has all the charts and graphs. This side has 62 actual stories. So seize this opportunity. Hopefully this video on Index Universal Life for Dummies has made you now a smarty.